Right now, shares of Navitas Semiconductor, trading under the ticker NVTS, are active on the Nasdaq at $9.47. The stock is currently in the red, down about 1.4% for the session as it struggles to find a floor. This price action follows the $9.12 mark seen shortly after the opening bell today, November 12, 2025. Many investors looking at that $9 handle might see a simple, volatile tech stock. But what they are actually witnessing is the brutal aftermath of a major strategic decision. This isn't just market noise, it's the sound of a company in the middle of a painful and public pivot. The expectation for Navitas has always been straightforward. It's a play on the next generation of power. The company is a pure play on gallium nitride, or GaN, and silicon carbide, or SiC, semiconductors. These are the advanced materials set to replace traditional silicon in applications demanding high power, high speed, and extreme efficiency. The narrative is that Navitas is providing to critical components for the AI data center boom, the electric vehicle adoption wave, and the green energy transition. The reality, however, is that this future-facing narrative just slammed headfirst into a very difficult present. The stock is currently trading down more than 20% from where it was just before its third quarter earnings report on November 3rd. That earnings call was the moment the expectation-reality gap became impossible to ignore. Navitas reported a non-GAAP loss of 9 cents per share, which was significantly wider than the 5-cent loss analysts had been forecasting. Revenue also came in light at $10.1 million, missing the consensus estimate of nearly $11 million. But the real damage came from the forward-looking guidance. Management projected fourth quarter revenue to be just $7 million. This wasn't a small miss. It was a signal that its current business operations are contracting sharply. This is the crux of the entire Navitas story right now. The company is in the process of deliberately walking away from its lower-margin business, specifically in the China mobile and consumer electronics sector. This was once a core part of its revenue, but Navitas has made the strategic decision that the future is not in low-margin phone charges. It's in high-power, high-value applications like AI data centers, industrial power, and solar energy systems. This is what management is calling Navitas 2.0. The problem is that the revenue from this new high-power focus is not yet large enough to fill the massive hole left by the old, abandoned business. The market, in response, has been unforgiving. The stock has been in a near free fall since those results, breaking through technical support levels as investors reset their expectations. The bullish narrative, which includes Navitas' inclusion in NVIDIA's new 800-volt AI ecosystem, is still intact, but it's a long-term story. The short-term story is one of shrinking revenue and missed targets. This strategic pivot has created a perfect storm for market tension, and it has attracted an enormous amount of short seller attention. This isn't just a handful of bearish bets. Navitas has become one of the most heavily shorted stocks on the market. Depending on the most recent exchange data, the short interest as a percentage of the free float is hovering around an astounding 30%. To put that in perspective, a short float of 10% is considered high. 30% is extreme. This means for every 10 shares available to trade, 3 are held by investors betting the price will fall. What is the short seller thesis? It's twofold. First, they are betting on the valuation. Navitas is not profitable. It has a deeply negative net margin and a negative P/E ratio. The stock trades at a price-to-sales multiple that is astronomically high, sitting over 50 times sales, while its industry peers trade at an average of just 7 or 8 times sales. This valuation is built entirely on the promise of future growth. The shorts are betting that this promise is either too far away or will not materialize at the scale required to justify the price. The second part of the bear thesis is the pivot itself. Executing a complete shift in your primary end markets is incredibly difficult. The shorts are wagering that Navitas will fail to scale its AI data center and energy sector business quickly enough, and that the company, which recently raised $100 million in a private placement, will burn through its cash before it can reach profitability. For investors, this creates a high-stakes environment. How do you track this? You can find short interest data updated twice a month on the official NASDAQ website or through financial data providers like Fintel or S3 Partners. What you're looking for isn't just the percentage of float. You also want to look at the days to cover. This metric tells you how many days it would take for all the shorts to buy back their shares based on the average daily trading volume. For Navitas, because its volume is so high, the days-to-cover ratio is often quite low, around 1.5 to 3 days. This means the shorts can get in and out quickly, reducing the risk of a sustained, uncontrolled squeeze. Another metric to watch is the borrow rate. This is the interest fee short sellers must pay to borrow the shares. Surprisingly, the borrow rate for NVTS has been relatively low, suggesting that despite the high short interest, shares are not yet difficult to locate and borrow. A sudden spike in that borrow rate would be a key signal that the supply of available shares is tightening, which could put pressure on short sellers. What's your take on this massive short position? Do you think the bears are correctly identifying the valuation and execution risk, or are they underestimating the demand from the AI boom? Comment below. When you look past this short-term battle, you find the actual business. Navitas designs and sells power semiconductors using gallium nitride and silicon carbide. For decades, power electronics have run on silicon. But silicon is reaching its physical limits. It's inefficient, it gets hot, and it's bulky. GaN and CK are wide bandgap materials that are fundamentally superior. They can handle higher voltages, switch on and off millions of times per second with almost no energy loss, and operate at much higher temperatures. This means a GaN power supply for an AI server can be half the size, waste far less energy as heat, and deliver power more reliably. In an electric vehicle, a CK inverter means a lighter car, faster charging, and a longer range from the same battery. This technological shift is not a question of if, but when. The entire gallium nitride market is expected to grow at a compound annual growth rate of more than 20% through the end of the decade, driven by exactly the markets Navitas is now targeting. The company's management is asking investors to look past the next 2 quarters, which they admit will be the revenue bottom. They are pointing to 2026 as the transition year, where the growth from AI, solar, and industrial applications will finally overtake the decline from the consumer mobile business. The bull case is that by 2027, Navitas will be a high-margin company purely exposed to the most significant secular growth trends in technology. The bear case is that this is too far away, and that larger, more established competitors will dominate the market by the time Navitas completes its transition. This is the expectation versus reality gap in its purest form. The expectation is that you are buying the next great AI supplier, but the reality is that you are buying a company in the middle of a painful strategic pivot with shrinking near-term revenue and a valuation that prices in perfection. The recent analyst activity reflects this dilemma. In the wake of the earnings report, several firms have downgraded the stock, moving from buy ratings to hold. Price targets are scattered, ranging from as low as $4.50 to as high as $13. The consensus rating is now a firm hold, as Wall Street waits on the sidelines to see if management can actually deliver on this Navitas 2.0 promise. For now, the stock remains a battlefield. Retail sentiment is divided. You see intense bullishness on platforms like X and Reddit, focusing on the NVIDIA partnership and the disruptive technology, while more traditional investors are pointing to the fundamentals, the cash burn, and the lack of profits. So where does that leave the stock? Navitas is asking investors for patience. The shorts are betting that patience will run out. The future outlook depends entirely on execution. The key signal to watch will not be this quarter's revenue, which we already know will be weak. The key signals will be announcements of new design wins in the AI data center space, progress in the automotive qualification pipeline, and any improvement in gross margins as the product mix shifts to these higher value chips. Any positive news in these areas could ignite the heavily shorted stock. Conversely, any delays or signs that competitors are winning these key designs could validate the bear thesis and send the stock searching for a new low. In summary, the story of Navitas Semiconductor is not about today's 1.4% drop. It's about a company that has willingly detonated its current revenue stream to chase a much larger, more profitable future. The expectation is a high-growth AI technology leader. The reality is a company in a deep and uncertain transition with a stock that has become a proxy war between long-term believers and short-term skeptics. This is a high-risk, high-reward scenario, and the winner will be determined not by market sentiment, but by whether the revenue from that AI-driven future arrives before the market's patience runs out. I'm curious, for those of you watching this, how many shares of Navitas do you currently hold, and what's your time horizon for this pivot?